You're listening to the Financial Source podcast on YouTube.
Welcome to the Financial Source podcast. We are looking at a really fascinating fracture in the global economic narrative.
We really are. It seems like the major central banks are just no longer moving in lockstep.
Not at all. It is Sunday, February 8th, 2026, and you've got the United Kingdom teetering on the edge of easing, Europe holding steady, but then Australia delivers a surprise hike.
And all that is happening while political shifts in Japan and delayed data in the United States are just clouding the entire horizon.
So today we're going to explore why inflation's pulse seems to be persisting in some regions, but fading in others.
And what all these signals mean for your portfolio in the week ahead.
Let's unpack it.
Great to be here. I mean, that idea of a synchronized global economy, I think it's officially dead. We're seeing more of a messy divorce between the major economies.
A messy divorce. I like that. So let's start with maybe the messiest room in the house right now, the United Kingdom. On the surface, the Bank of England held rates at 3.75%.
Right.
Seems boring, but I was reading the meeting minutes, and it felt less like a technocratic meeting and, well, more like a mutiny.
It was absolutely a mutiny. I mean, in central banking, you want to project a united front, right? It shows confidence.
Sure.
But here, the vote split was 5-4. 5 voted to hold, but 4 voted for an immediate 25 basis point cut. That is a razor-thin margin.
Wait, hold on a second. If 4 of the most powerful economists in the UK are screaming cut, and only 5 are saying wait, that tells me the people voting to cut are seeing something genuinely scary in the data.
You've hit on the psychology of it perfectly. Central bankers are terrified of being behind the curve. The 4 dissenters are looking at the UK economy and seeing demand just falling off a cliff.
So they're basically saying, if we keep rates this high, we're going to cause a recession for no reason.
Exactly. And honestly, the Bank of England's own guidance sort of backed them up. They cut their inflation projections and even admitted that the risks of inflation sticking around are, and I'm quoting here, less pronounced.
So if the data says cut, and almost half the committee says cut, why is Governor Bailey still holding the line? I watched his press conference, and he looked like a man trying to ride 2 horses at once.
He's in an impossible position. He knows, and he did admit this, that rates need to come down. But he is terrified of that stop-start error.
That's where you cut too early, inflation flares up again, and then you have to hike them right back up 6 months later.
And that just destroys your credibility. He specifically pointed to the mortgage market as the reason for his caution.
Why specifically mortgages? Is the UK market that different from, say, the U.S.?
Oh, a huge difference. In the U.S., you might lock in a 30-year rate and just forget about it. In the UK, mortgages reset much more frequently. Maybe 2 years, 5 years.
So the transmission mechanism of monetary policy, how fast those rate hikes actually hit your wallet, is much more violent.
Much more. Bailey is essentially saying we need to see how this recent refinancing wave plays out before we take our foot off the brake.
Okay, but the market isn't really buying that patience argument, is it?
Not at all. Before this meeting, traders thought the next cut would probably be in July. As soon as that 5-4 vote count hit the terminals, the whole timeline just collapsed.
So what are they betting on now?
The market is now betting heavily on an April cut. They see the dissenters, they see the weak data, and they're basically saying Bailey is going to be forced to fold.
So the UK is panicked about a slowdown. Now, let's look at the complete opposite scenario. Australia. I feel like I have whiplash.
It's a total divergence.
While London is trying to figure out how to cut, the Reserve Bank of Australia just hiked rates for the first time in 2 years.
Yep, they raised the cash rate to 3.85%. And unlike the UK, this decision was unanimous. No drama, no split vote, just a collective agreement that inflation is not dead.
Governor Bullock used this phrase I found interesting. She said the pulse of inflation was too strong. What does she even mean by pulse? Is that just a fancy way of saying prices are high?
It's a bit more nuanced than that. When she talks about the pulse, she means the underlying momentum of price increases, especially in the services sector. You know, things like haircuts, insurance, dining out.
Sticky stuff.
The really sticky stuff. In Australia, wage growth is still ripping higher, and private demand has been surprisingly resilient. The economy just isn't cooling down like they expected.
But didn't they also change how they measure that? I saw something about trimmed mean inflation forecast going up.
Right, and trimmed mean is a great concept for you to understand. Think of it like Olympic gymnastics scoring.
Okay.
You know how they throw out the highest score and the lowest score to get the real fair average? That's what the central bank does with prices. They strip out the crazy outliers to see the real trend.
And the trend is ugly.
The trend is pointing the wrong way. The Reserve Bank of Australia looked at that trimmed mean and realized they had a problem, so they hiked. But here's the bitter pill. To get inflation down, they are explicitly planning for lower growth in the future.
So they're intentionally engineering a slowdown to kill this pulse.
They are bracing for a long war. Their models now assume rates will stay above 4% all the way through the end of 2027. That is a massive shift for anyone holding Australian assets.
That's a good point. If I'm sitting in New York or London, why should I care about Australian interest rates?
Because capital is like water. It flows to where the yield is. If the UK is cutting rates and Australia is hiking them, investors are going to sell the British pound and buy the Australian dollar to get that higher return.
And that creates volatility.
Exactly. It creates volatility in the currency markets, which eventually impacts the cost of everything from your imported wine to global commodity prices.
That makes perfect sense.
Yeah.
So we have the UK folding, Australia doubling down. Let's talk about the ones standing still. The European Central Bank and the Bank of Canada both held rates.
Right. But holding can mean very different things depending on why you're doing it.
Okay, so what's the story with the European Central Bank?
For them, holding is a sign of confidence. President Christine Lagarde is basically saying, we're okay. The Eurozone economy is resilient, unemployment is low, they feel like they're in a pretty comfortable spot.
But she did mention the currency, right? The euro has been appreciating against the dollar.
She did, and that's a key detail. A stronger euro is actually doing the central bank's job for them. When the euro is strong, it makes imports cheaper.
Which naturally dampens inflation.
Exactly. So Lagarde can afford to just sit back and wait because the currency markets are helping her fight the inflation battle.
Now compare that to Canada. They also held rates at 2.25%, which is pretty low compared to the others. But Governor Macklem sounds stressed. He keeps talking about structural shifts.
Canada is in what is, for a central banker, a nightmare scenario. Macklem is worried that the economy isn't just out of gas, which would be a cyclical problem you can fix by cutting rates.
He's worried the engine's actually broken.
That's a great way to put it. He's worried it's structural. Specifically, following the deterioration in trade relations with the United States, Canada's actual ability to produce goods and services, its productive capacity, might have permanently dropped.
Let's break that down for a second. If the economy is just out of gas, you cut rates, people borrow, they buy stuff, the economy grows.
Correct. That's the standard playbook. But if the engine is broken, if you have these supply chain walls and trade barriers, and you cut rates to stimulate demand,
You don't get growth, you just get higher prices.
you just get inflation. People are bidding for goods that simply cannot be produced at the same level as before.
That sounds dangerously close to stagflation.
It smells a lot like it. And that is why the Bank of Canada is basically paralyzed. They can't cut rates to help the economy without risking a huge inflation spike. The market sees this too. Traders are pricing in almost zero movement for the rest of the year. They're stuck.
Speaking of being stuck between a rock and a hard place, let's talk about Japan. Today is Sunday, February 8th. The polls are open as we speak. This isn't just an election. It feels like a referendum on the entire economic direction of the country.
It absolutely is. Prime Minister Takaichi called this snap election to try and lock in a supermajority for her coalition. We're talking about the Liberal Democratic Party potentially grabbing 2/3 of the seats.
And if she gets that kind of power, what does she do with it?
She spends. Takaichi is a big proponent of aggressive fiscal expansion. She wants to flood the economy with government spending to really juice growth.
Okay, so government spends money, stock market goes up. Is it that simple?
In the short term, probably yes. The Nikkei would likely rally. But here is the trap. The bond market. If investors think the government is going to spend recklessly, they're going to demand a much higher risk premium to lend money to Japan.
Is this what people mean when they talk about the yield curve steepening?
Exactly that. A steepening curve just means that the interest rate on long-term bonds like the 10-year or 30-year shoots up much faster than short-term rates. Investors are basically saying, if you want my money for 10 years while you go on a spending spree, you have to pay me a lot more.
So how does the Bank of Japan react to that? If the government is stepping on the gas pedal, does the central bank have to slam on the brakes?
They might have no choice. But there's another layer here. Wages. We're also getting the December cash earnings data today. And the Bank of Japan is obsessed with this idea of a wage price spiral.
We hear that term a lot. What does it actually look like on the ground?
It's a feedback loop. Workers get higher wages, and winter bonuses are expected to be strong. They take that extra money and they spend it. That pushes up prices.
Then companies see higher prices and higher labor costs, so they raise their prices even more. And around we go.
And around we go. If that cycle gets confirmed today and you combine it with a big Takaichi win, the Bank of Japan will have all the ammunition they need to start hiking rates in the second quarter.
So the government steps on the gas, the central bank slams on the brakes. That sounds like a recipe for a very bumpy ride for the yen.
Massive volatility. But if Takaichi loses, the whole trade flips. A loss means gridlock, less spending, and probably a stronger yen because the central bank won't have to fight the government. The stakes today are incredibly high.
It's just wild that we're looking at Japan as the source of volatility.
Yeah.
Usually that's the U.S.'s job.
Which brings us to the week ahead. The calendar is a mess because of that partial government shutdown.
It is a mess. We're getting the January jobs report rescheduled to Wednesday, February 11th. And the big one CPI inflation is now on Friday, February 13th.
Friday the 13th. That feels a little ominous for an inflation data release.
I know, right? You can't make this stuff up. If that number comes in hot on Friday the 13th, the superstitious traders might just close their laptops and go home for the day.
But looking at the tea leaves, the U.S. economy seems, well, fine. I keep waiting for the recession that just never seems to arrive. Fine is the perfect word. It's resilient. Take a look at the labor market. We're not seeing mass layoffs. Jobless claims are still low. What we're seeing is attrition.
You mean like ghost layoffs?
Exactly. Companies aren't actively firing people. They're just not replacing the ones who leave. It's a soft cooling. The unemployment rate is holding steady around 4.4%. It's not a boom, but it's definitely not a bust either.
What about on the inflation front? Federal Reserve Chair Powell keeps bringing up tariffs. Is that just an excuse?
It's his main argument right now. He admits inflation is elevated, but he says it's a one-off event caused by tariffs raising the price of imported goods.
Okay, explain that distinction. Why does it matter if it's a one-off or not? Inflation is inflation, right? I'm still paying more at the store.
It matters for policy. If inflation is persistent, it means overall demand is too high, and you have to hike rates to crush it. But if it's a one-off or a level shift, like a new tax or a tariff, prices go up once, and then they stabilize.
So you don't need to hike rates for that.
You don't. You just wait for it to wash out of the year-over-year data. Powell is betting this is just a temporary bump, not some new, entrenched trend. He's playing the waiting game.
All right, just quickly before we wrap up, let's touch on China. They're releasing data this week, too, but they have the complete opposite problem, don't they?
A completely opposite problem. While the U.S. and Australia are fighting inflation, China is fighting deflation. Producer prices, the cost of goods at the factory gate, are actually falling. They're at minus 1.9%.
What does that mean for the rest of the world?
It means China is exporting deflation. Because their domestic demand is so weak, they are flooding the global market with cheap goods just to keep their factories running.
So, cheap Chinese exports might actually be helping Chair Powell with his inflation problem.
It's the strange silver lining in all this. China's economic pain is, in a way, acting as a subsidy for Western consumers. It's one of the few things keeping global inflation from spiraling even higher.
It's just incredible how interconnected this all is. You pull on a thread in China, and it loosens a knot in the U.S., while maybe tightening a noose in Australia.
That's the perfect way to visualize it. And that is why this week is so critical. You have the Japanese election results coming in, and then that big U.S. data dump later in the week.
So that whole narrative of synchronized global stabilization is pretty much out the window.
Far from it. We are in a world of local realities now. You have to look at each country's specific pressures and constraints. The era of just buy everything or sell everything is over. You have to be selective.
That's it for today. Thanks for being here.
Appreciate you tuning in. Join us again on the Financial Source podcast.